Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets the market tries to hide with a smirk. Today we are diving deep into TransDigm Group's latest filing, a move that looks like they are raising a massive amount of cash to give some back to the shareholders. Talk about a party. Get ready because TransDigm just pulled off a huge financial maneuver and $5 billion debt offering and a special dividend payout that's worth talking about. Alright, so what exactly did TransDigm do? They basically took out a huge loan, not just one loan, but a whole package deal totaling about $5 billion. This happened on August 19, 2025. This money is coming in through different avenues. We have $500 million from something called senior secured notes, which mature in 2034 and pay an interest rate of 6.254 and pay an interest rate of 6.750 in 2034, but with a slightly higher interest rate of 6.750%. And finally, $2.5 billion from what they call new term loans, which are due in August 2032. Now, for the really juicy part, why are they borrowing all this money? Well, it's to pay out a massive special cash dividend to their shareholders. That's a whopping $90 per share, and that's not all. They are also giving out similar cash payments related to their stock options. It's like a big thank you party for everyone involved, including covering some fees and expenses. Let's get a bit more specific about these secured notes. TransDigm took on $500 million of these notes. The deal was struck on August 19, 2025, selling them at their full value. Basically, they sold these notes to big institutional investors who are considered qualified buyers and also to those outside the US following specific rules. These notes are governed by a formal agreement called an indenture. It lays out all the terms and conditions between TransDigm as the company borrowing the money, TD Group as the parent company, and various subsidiaries who are acting as backup guarantors. The Bank of New York Mellon is playing a key role here as the trustee, and a collateral agent keeping everything in order. So how much does this loan cost TransDigm in interest? Well, these secured notes carry a 6.250% annual interest rate. They started counting from August 19, 2025, and the interest gets paid out twice a year in January in 2026. Like any loan, there are got out clauses. TransDigm can choose to pay back some or all of these notes early under certain conditions. Also, if the company or its major subsidiaries go through big changes like a change in ownership or sell off significant assets, they are actually required to offer to buy back these notes. Now, this is important. These secured notes are considered top-tier debt, meaning if something goes really wrong, they get paid back before other types of debt TD Group, and certain subsidiaries are guaranteeing these notes, which gives them more backing. This agreement also includes important rules for TransDigm. They can't just go out and borrow a ton more money or make certain risky moves without following these rules. This limits their flexibility a bit, but it's standard practice for companies managing large debt loads. Moving on to the senior subordinated notes, of which they issued a massive $2 billion, also finalized on August 19, 2025. These were also sold to qualified institutional buyers and foreign investors under specific regulations. Similar to the secured notes, these subordinated notes also have an indenture. This agreement lists TransDigm as the issuer TD Group and other subsidiaries as guarantors, and the same trustee from the previous deal is involved. These notes have a slightly higher interest rate at 6.750% per year. Again, interest accrues from August 19, 2025 and is paid out twice a year starting from January 2026. Now, the key difference here is the term subordinated. These notes are still considered debt, but they are lower in priority than the senior secured notes. This means if the company runs into serious financial trouble, holders of these notes might not get paid back until the senior secured note holders are fully satisfied. Just like the secured notes, this indenture also comes with rules limiting TransDigm's actions regarding future debt payments, investments, and major business decisions. Finally, we have the credit agreement amendment. This is where the $2.5 billion in new term loans come into play. This amendment was also signed on August 19, 2025, updating their existing credit agreement. These loans are tied to something called term SOFR plus an extra 250% interest margin. There was also a small upfront fee of 0.25% paid to the lenders when these loans were first issued, basically a cost of getting the money. This amendment modifies a much older credit agreement from 2014, and Goldman Sachs Bank USA is the main bank. handling this loan as the administrative and collateral agent. The filing also mentions a press release from August 20, 2025. This is where they officially announced the special dividend of $90 per share and the dividend equivalent payments on stock options. This confirms the purpose of all that borrowed money. Now, while this report is mostly about the debt and dividend issuance, it's worth noting that attached are all the nitty-gritty legal documents. This includes the indentures for both sets of notes and the amendment to their credit agreement. Think of these as the detailed rule books for all these financial deals. So what's the big picture here? TransDigm is essentially using debt to fund a massive payout to shareholders. This is a pretty aggressive strategy. It shows they are confident in their ability to generate enough cash to service this new debt and still reward their investors. Let's think about this like Warren Buffett with TransDigm is taking on a significant amount of debt, which increases its financial risk. If their business performance falters, paying the interest on these loans could become a real challenge, especially with those higher rates on the subordinated notes. However, the fact that they are paying such a large dividend suggests management believes the company's future earnings power is strong enough to support this. They're betting on continued profitability and stable operations to manage this debt structure. Is this good or bad? It really depends on execution and market conditions. If TransDigm's underlying business continues to thrive, this could be a smart move to enhance shareholder value, but if the economy weakens or their industry faces headwinds, this large debt load could become a serious concern. The risk is clear. If revenues or profits dip, the interest payments on the $5 billion become a much heavier burden. This is not a company that's being overly conservative right now. They're leveraging up to return capital. The opportunity is also there if they can continue to grow and generate strong cash flows. They become a more attractive investment because of that dividend payout. In my opinion, TransDigm is playing a high stakes game. They are leveraging their future earnings potential to reward current shareholders. This is a bold move, and investors will be watching very closely to see if they can successfully manage this increased debt while continuing to grow the business. What's your take on this massive debt and dividend strategy from TransDigm? Do you think it's a smart move or a risky gamble? Let me know your thoughts in the comments below. If you found this deep dive helpful, please hit that like button and subscribe for more corporate breakdowns. Also, make sure to join our Time Kerpesam Baktam and subscribe for more corporate breakdowns. Also, make sure to join our Discord community linked in the description below for even more insights. Thanks for watching and see you next time.